The July employment report showing a gain now of 187,000 jobs last month. That is below expectations of 200,000, and the unemployment rate ticking down to 3.5%. We're, of course, also paying close attention to Apple and Amazon after both the tech giants reported quarterly earnings diverged a bit. Joining us right now to talk about all of this, Dan Niles, founder and senior portfolio manager at the Satori Fund. Good morning to you. Let's go broad first, given the jobs numbers, given maybe what you think the Fed is or isn't going to do as a function of it, and just the run, frankly, that the equity market has been on. Where are you broadly right now?
I mean, right now, it wouldn't surprise me to see a 10% correction between now and year end, because I think the main thing is you're now getting to much more difficult compares relative to inflation. CPI peaked at 9.1% in June of last year. And if you look at what's going on right now, you've got about 50% more job openings than people unemployed. Average hourly earnings are up 4.4%. You've seen all these strikes going on. And the big thing underneath this is oil is surging. It was down about $67 back in the middle of June. It's now over 80, and that feeds into a lot of costs. And then in addition to that, between what Japan's doing with yield curve control and the U.S. Treasury having to go ahead and issue about $1 trillion this quarter, $850 billion in Q4, that's going to put upward pressure on yields. And that's really been a big driver of multiples expanding, because it hasn't been earnings. Earnings are down this year. It's the multiple going up. So we'll see what
Dan,
happens.
though, how convicted are you that we're going to have a 10% effectively correction if that was the case? Well, I mean, on a relative basis to where we are you shorting things? What are you doing?
You got to remember, we run a concentrated portfolio. It's about 20 to 40 stocks. And so for us, it's about stock picking. So, I'm long Amazon. It's the largest position in my fund, and that's with the backdrop where I'm concerned about this. But on the same side, we're, short Apple. So for us, it comes down to stock picking to get us through this. That's what had us making money last year in a very down tape for the market. That's what has us making money this year in an up tape for the market. So, the multiple right now, Andrew, at 3% CPI, if you look back over 70 years of data, the average S&P multiple is 19 times. It's sitting at 21 times. So to get it just back to average, if you're worried about inflation maybe ticking up higher than what people think after 10 months of downside surprises to headline CPI, that's a 10% correction in the multiple, which is a 10% correction in stock prices.
Dan, you said something fascinating, and then I want to bring Steve Leisman into this, but you just said that you were long Amazon in this environment and you are short Apple. Your expectation for where Amazon is then in 6 or 12 months, and where do you think Apple is?
Well, look at it this way with Apple. People can say whatever they want about, services, et cetera, driving revenues. But remember, Apple in fiscal 19, before COVID hit, their revenues in fiscal 19 were down 2%. They've now had 3 down year-over-year quarters in a row, and they guided to a fourth. That hasn't happened in 20 years. Now, that wouldn't matter, except the stock's trading at a 30 PE. The S&P is trading at a 21 PE. And Apple has no revenue growth this year. You compare it against our favorite pick coming into this year, or top 5 pick, Facebook. Facebook is growing revenues 13% this year and trades at a 24 multiple. Or you look at Google, 8% revenue growth this year, trading at a 23 multiple. So, if you want to look at Apple and ignore the multiple, that's great. And the multiple is what's driven the entire stock move this year. Earnings went down after they reported the March quarter. Earnings went down again after they reported this June quarter. Multiple keeps going up. That's terrific if you own it, but that's not a game I want to play, counting on multiple expansion offsetting earnings going down.
Dan, I want to get back to what you were talking about stock picking. I think it's kind of interesting that you get this this tandem here, Apple and Amazon, both going different ways, different movements in the stock. Is this period here where you could just buy big tech, is that over? And then how do you replace that? Is it you just can't go buy QQQ now? Is that the essential idea that it's stock picking?
That's 100% correct, Steve. And you've seen that with results even. Microsoft guided their intelligent cloud business below expectations, not by much. But remember, they are a major investor in OpenAI, which has ChatGPT. and their numbers still went down for Intelligent Cloud. You look at Tesla, they went down on earnings. You look at Netflix, they went down on earnings. You look at Apple, unless something changes, they're going to be down on earnings because they weren't that great. But you look at Google, Meta, Amazon, they're all up big on earnings, and they should be because the numbers are going up after they reported. So this whole Magnificent Seven trade by the Qs, as you put it, yeah, I think that's gone, especially with where we are on 10-year Treasury yields. And the fact that not every company is NVIDIA. And, Fortinet, which you mentioned earlier, security, absolutely bulletproof. What could possibly go wrong? AI is driving so many security threats, companies are going to have to spend more. Guess what? In a year of efficiency, if you're spending more on NVIDIA chips, you're taking it out of other portions of your budget. And that's what you're seeing. And it's not just Fortinet. You've seen that with the networking companies, Juniper, CommScope, Nokia, Ericsson. You've seen it with Accenture, IBM, Infosys as well. So all these companies may say AI 50 times on their earnings releases, but it doesn't mean that there isn't bifurcation amongst the sector going.